Ladies and gentlemen, welcome back. This is Christopher Aaron. This is the iGold Advisor channel. It is August 27th, 2024, and we are going to look at the gold to silver ratio because the gold to silver ratio gives us a very important signal as to whether or not silver is ready to skyrocket. A lot of people making this claim. However, what does the actual real world data show us? Does it show us that silver is going to skyrocket, or is there another path that silver needs to take? Make sure to subscribe to this channel and hit the bell icon to be notified when these free videos come out on YouTube. If you have one moment to give it a thumbs up, if you would like to, I just want to let you know that I would really appreciate it. It helps out the algorithms here on YouTube. Last but not least, make sure you follow our free account on X, or Twitter as it used to be known, at iGlobalGold. Sometimes I post free updates there during the middle of the week for you. Okay, let's look at this signal, the gold to silver ratio. What does it show us about silver getting ready to skyrocket? Our legal disclaimer. First thing I want to do is actually challenge you guys, and I want to remind you here, because there's a lot of people producing videos, there's a lot of people producing analysis, and I just want to remind you for one moment that all knowledge has a cost to it. Yes, even the knowledge that appears to be free here on YouTube, it's not actually free. And I want you to think about the ways that you can pay sometimes for this knowledge when you're not really thinking about it. The first way that you can pay is through trial and error, right? If you go out and you just say, well, I'm going to learn everything on my own. Well, the way that you're actually going to pay for that is because you're going to make mistakes along the way. Not just you, everyone is going to make mistakes. I've made mistakes. We all make mistakes if we go by trial and error. Now, the difference in this instance is if you make mistakes, you're going to pay through the value of your portfolio going lower. You're going to lose money if you use trial and error, right? So this is a way that some people choose to pay. They want to learn it themselves, and that's fine. The second way that some people pay is because they get this free, quote unquote, free fundamental analysis, right? Whether it's other people producing videos or articles or free, quote unquote, lectures or seminars, right? And they think, well, wow, I finally got something for free. But the problem with that is that most people are not thinking about how they are actually paying for that, quote unquote, free analysis. And if we really divide it out and think about it, there are two ways that we can pay if we listen to the, quote unquote, free analysis. One is by listening to pumpers. And these are individuals who are publishing free analysis, but then what they're actually doing behind the scenes is they're taking the inverse of what they tell you to do. So if they say, hey, there's this investment that I think is going to go higher, and they get everyone to buy it, what they're actually doing is they are selling behind the scenes to you. And so the way that you are paying is because you're buying the investment from the pumper who has owned it for some time. They get the price to go up. They sell to you. The price goes down. You pay for it if you listen to the free pumpers. So you need to be really careful for that. That's A. And then the second one, this is a little more tricky, is the storytellers. And these are the individuals who are literally coming out week after week or month after month and telling you a story. And the story can sound really, really elaborate. It can sound really well thought out. But the key to know that you're listening to a storyteller is they're never going to share the actual data with you. They're never going to present it in a visible format like a chart or a graph or a pie chart or a way, or you can look at supply and demand, right? They're always going to be telling you a story. And so just remember that these storytellers are actually paid just to have you listen to the story week after week. They get paid via advertising. Now, if you listen to either the pumpers or the storytellers, you are also going to pay sooner or later by the same thing as the trial and error, the portfolio cost. Because you're either going to be listening to these people that are taking the inverse of what they're telling you to do, or you're going to pay because they have no interest in you actually making money. They just want to keep you listening to the story so they can collect the advertising fees. And I just want to tell you something. When I first started studying this sector, the precious metals sector, we're talking back now in 2007, I paid both of these costs. I did this trial and error first, and I paid by losing money. And then I also listened to both the pumpers and the storytellers, and I paid by losing money, portfolio cost. And so what I said is that when I'm ready to start publishing research professionally, what I'm going to do is I'm going to take the third way, the third business vehicle that exists out there, which is to offer independent research. The other way you can do this is independent management if you're going to hire someone to manage the money for you. But independent research or management, and of course the way that you pay for that is simply upfront, right? Now here on YouTube, I gave away little snippets. I sometimes give these 5 or 10 or 15 minute snippets. But of course, I always tell you that you're only receiving a small portion here of what I charge for our premium subscribers. So I've taken this upfront model because I paid these myself going back 10, 15, 20 years ago. And I said, let me try to save some people the portfolio cost and instead offer this as an upfront cost. So I just want you to keep that in mind when we get to what? Here we are, the data, right? Remember, one of the ways that those storytellers get you to keep believing their stories is they never actually present any real world data. My model is to show the data, show the graphs, show the charts. If it's bullish, I tell you it's bullish. If it's bearish, I tell you that it's bearish. And I'm willing to bet that there are individuals out there that value independent data and that will be willing to pay for it either sooner or later by the model that I've chosen, the upfront model. So here is the gold to silver ratio. Here's the history going back from 2000 to the present. Pay attention with me to what we saw here first in early 2004. Notice this breakdown in the gold to silver ratio. Notice it was rising for a few years, and then here, the orange circle. Notice that the ratio broke lower. So when the ratio breaks lower, it means that silver is outperforming gold. And ironically, when silver outperforms gold, it actually tends to be good for both precious metals. It tends to be that when silver is outperforming gold, gold is also rising. So in other words, we want to see the gold to silver ratio moving lower because it tends to be good for the overall sector. Okay? So notice that when we saw this signal here in early 2004, that in the next 3 months, silver rose by 41%. This is a big move. 41%, if you think about that, in just 3 months. Let's look at some of these other times that this signal has shown up. Again, my business model is simply to show you the data and try to explain to it in as logical a way as possible. Notice that when this ratio broke lower, here again in favor of silver in early 2006, notice that the price of silver rose by 56% in 2.5 months. This would be in today's terms like silver rising by $25 in 2.5 months. That's a dramatic move, right? And so follow along with me here. Just look at the other times that this gold to silver ratio has broken lower here over the last 25 years, right? This brings us all the way to 2020. Notice that each time, I mean, look at this time here, 160% in 8 months, 30% in 2. It's always these big surges in the price of silver when this gold to silver ratio breaks lower. So, suffice it to say, if you're bullish on precious metals, you want to see this gold to silver ratio moving lower. Okay, let's fast forward to the present. Let's just look at a quick summary here. Take the average of all these cycles, and it comes out to 59% gain in 3.3 months. In today's terms, with silver trading just below $30 per ounce as this is being recorded, that would be like silver moving up to $47.70 if it did the average of all these green signals here from the last 25 years. Okay, so suffice it to say, this is very important, what happens to the gold to silver ratio. If you look at it, basically every major surge in the price of silver coincides with this breakdown signal in the gold to silver ratio. Let's take it here to the red shaded area and now zoom this in on the current. What has happened here going back from the coronavirus panic? And what I want to do is just put up these labels to remind you, if you're new to studying the gold to silver ratio, in the most basic terms, remember, the lower that this ratio goes, the better it is for both precious metals. And the higher that this ratio goes, the worse that it is for both precious metals. And the best example of that is right up here, the highest level that we've ever seen on the gold to silver ratio, 128. This is when both gold and silver crashed. So we want to see this ratio moving lower. Now let's take a look at the current model here from 2020 through the present. And just take a look with me how many times the gold to silver ratio had been bouncing along this blue double band, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 times over the last 3 years. So clearly this had been a rising trend in the gold to silver ratio. Remember, when the trend is rising, it's worse for precious metals. We don't want to see this trend rising. And then notice here, just 3 months ago in May, that this gold to silver ratio finally broke lower through this 3-year trend. So this was a big breakdown. This is when silver surged up to $32.50. So everything was looking great. Remember, I am choosing the business model here of saying some of you out there are going to value independent research and analysis, and you're not going to simply get upset if I say something that might indicate that precious metals are not going to skyrocket. I think there are some individuals out there who value honest research and analysis. So here was the breakdown. That was good. That's what we wanted to see. But then notice right here, just 4 weeks ago, when there was a major deleveraging event that happened in the Japanese yen carry trade was unwinding. Notice that this ratio broke again back upward. It broke upward, which is worse for precious metals. We saw silver fall from 32 back down to 26. And so what does this mean here? When we have a very clear trend that breaks lower but then breaks back higher, that right there becomes a false breakdown. Exactly what it sounds like. It couldn't sustain the breakdown. So at the current moment, if you were to ask me, what is the gold to silver ratio telling us right here? We had a 3-year rising trend. It tried to break lower, but it failed to stay low. It was a false breakdown. And then it surged back up again. I would tell you that my outlook for the gold to silver ratio, until proven otherwise, is like this. So what happens if you have a false breakdown, the market goes back to the former trend. The former trend was higher, right? All these blue hits here on the double band. And so the gold to silver ratio is still now in a period of time where the market wants to trend higher. And what I want to show you, remind you, is that that would be considered worse for precious metals prices. And so you might be saying, okay, well, when is the moment that we might have another breakdown again, which would be better for precious metals prices? There's always a level that we define where we know that that is actually occurring. And that level is right here, 80.3. It's the lower boundary of this blue band. 80.3 ounces of silver to buy 1 ounce of gold. If we can get this ratio breaking back below 80.3, once again, it would be better for precious metals, and it would signify that perhaps we are ready for that moment where silver is going to truly skyrocket. Let's go back to the big picture model. So we looked at all the previous examples. Remember, that's why we want to see the precious metals ratio here, the gold to silver ratio. That's why we want to see it breaking lower. Unfortunately, here in the most recent instance, what did we see? The false breakdown. You can see it right there. It broke lower and then back above. The other point that I want to make right here is that this is the first time in freely traded precious metals history, first time going back to 1971, that we have seen a false breakdown of this magnitude in the gold to silver ratio. So it is showing us that something different is happening this time. It is showing us, once again, if you want to listen to the pumpers, stop this video right now. I'm about to give you the takeaway. But if you'd rather listen to pumpers, stop this video so you can go watch one of the other thousands of paid pumpers or paid advertising channels out there. I don't do either of those. I don't accept advertising on my channel. Trust me, every single week I have precious metals companies or mining companies that offer to pay me. And I say, no, that's not my business model. Because I'm willing to wager that there are some individuals out there that actually value independent research. Once again, I'm going to give you the takeaway now. This is the first time in history that we've seen a false breakdown in the gold to silver ratio of this magnitude. You can see all the previous examples here going back to the year 2000. And in our premium subscription service, we have looked at every single example going back to the year 1971. So it's telling us that something different is getting ready to happen now. And it is telling us that no, at this moment, until we see that ratio breaking back below 80.3, silver is not getting ready to skyrocket. Now look, if we see that ratio breaking lower a week from now, nothing would make me happier, because then I can come out here and produce an update and we can talk about that bullish signal. But I have to actually see it in order to say that I see it. Do you see what my business model is? Okay, no storytelling here. If you would like to follow along with us and take this to the next level, in our premium subscriber update that goes out on Thursday morning, we are going to be talking about signs of a silver top. And so in our premium subscription service, which is called Precious Metals Intelligence Plus, we will be talking about this signal that you've just seen and about a dozen other signals that all go into the model. And then we take the sum of all the signals and we say, what is that showing us on a highest probability? And we do this every single week for investors who value independent research. Remember, you get this in premium member-only videos. Not only do we cover the gold to silver ratio, we also cover physical gold, physical silver, the mining sector. We cover Bitcoin, the U.S. stock market, U.S. currency market, foreign exchange currencies, as well as the exact open market investments that we are making here with flash updates going right to your inbox when we make a decision. So if you are heavily invested in the precious metals sector or thinking about it, and what I said at the very beginning finally rings home, that, wait a minute, why am I listening to companies that sell precious metals as if they're going to give me an unbiased opinion? Of course not. They have a vested interest in you buying. Why would you listen to them? I don't understand it. Consider joining us in Precious Metals Intelligence, fully independent research. If you would like to sit down and speak with me, Christopher Aaron, one-on-one, know that you can book a consultation right on our webpage. This is when your situation requires taking the sum of the information and applying it to your specific situation. If you're 25 and you have $1,000 to your name, that is a vastly different situation for how you might think about investing in precious metals compared to if you're 75 and you are in retirement and you've got a couple $1,000,000 invested in the sector. Hugely different ramifications for what you might think about based on the research that we are presenting here. So if you'd like to speak to me, know you can reach me and book that consultation right on the webpage. We sit down and we talk one-on-one just like we're doing right now. Last but not least, if you're a higher net worth investor, you have to understand the power of private placements. And we're going to keep doing both gold, silver, but we're expanding into copper, uranium, other commodities over this next year. And remember, in the private placement investments, you get even more leverage compared to when you buy these investments in the open market because you get free warrants with every single investment that you make. And the warrants allow you to take your risk capital off the table and at the same time retain those warrants for risk-free upside after the required 4-month hold period is over for these investments. So this is extremely powerful way that investors can get exposure to precious metals and commodity companies while actually limiting their risk. Elite private placements is the service for you. Glad to have you here listening to this. Remember, there are always challenges and little hoops and twists and turns to navigate in the markets. And that is simply why I'm here, to provide the best objective, unbiased analysis possible in the precious metals markets. Thank you.